Let me tell you something that might actually sound crazy. At one point I had around 50 funded accounts at the same time. 50 of them across multiple prop firms, different instruments, different rules, and you will think that is a dream, right? More accounts, more capital, more payouts, more money. That is what every trader thinks that scaling means. But it is not. It's not even close. Because here is what actually happened. I scaled too fast at one point and I had a bad run that blew multiple accounts at once. Not just one account, multiple accounts in the same week. And when you are running that many accounts, a bad run does not just cost you one account. It costs you a chunk of everything you built so far. That experience taught me something that fundamentally changed how I think about scaling. And it is actually the opposite of what most educators tell you. Most educators will tell you to add accounts as fast as you can. Pass a challenge, get another one, stack them up, scale aggressively. That is how you grow. I'm going to tell you the opposite. Scaling is not about how many accounts you can own. It is about how many accounts you can actually execute on properly without quality dropping. And those are two completely different numbers. I have 8 years under my belt, over $2 million in payouts across around 1,000 different withdrawals. Today I want to show you the actual system I use to scale, when to add, when to stop, and how to manage multiple accounts without spreading yourself thin. And also how to avoid the mistake I made that almost took everything out. We have 5 layers into this one, so let's just get into it. Layer 1 is when to add your second account, because this is where almost everyone makes the first mistake. You just got your first fund account, you are feeling confident. You even maybe hit a payout or two and you are thinking, I should get another one, stack the capital, double the income. Obvious move, right? But not yet, not even close. Here's what I actually did and what I tell anyone who asks me this. I do not add a second account after one payout. I do not add a second account after 3 payouts. I add a second account only once I have a cushion of withdrawn profit saved up in my bank account. That means real money, not paper profit on a prop firm dashboard. Actual cash sitting in my bank that I have already pulled out from payouts on the first account. Why does this matter? 2 reasons. First reason, the cost of a second challenge is real. Let us say a funny challenge costs you $300. Before you buy that second one, you need to have paid off the cost of the first one completely from withdrawn profits and have at least another $300 sitting in your bank to cover the new one. Otherwise, you are kind of gambling with money you do not have. Second reason, and this is the bigger one, if you can hit payouts consistently on the first account for a few cycles in a row, that is the first real data point that your process actually works. Not a theory, not a feeling, just data. One payout can be luck, but 3 payouts in a row with no rule breaks, that is a good pattern. Now, before that pattern exists, you do not have anything to scale yet. You will just be multiplying an unproven process by 2, which is worse than just running one account properly. So my rule here is simple. Consistent payouts on account 1 plus real cash cushion in the bank plus a challenge cost that is paid for in withdrawn profit. Those 3 boxes are ticked, you can consider account 2, but not before. This is the correct way of scaling up, especially if you are a beginner. Now layer 2, and this one is where scaling actually starts getting complicated. Once you have more than one account running, even just 2 or 3, the question stops being about strategy and becomes about bandwidth. Let me explain what I mean. When you are managing one account, you have one set of rules to think about, one drawdown to track, one daily loss limit, one set of positions open. Your brain can handle that easily. But when you have 3 accounts, you now have 3 sets of everything. 3 different daily loss limits that might be slightly different. 3 different drawdowns, 3 different rule sets because different prop firms have different rules. And 3 sets of positions that need to be monitored at the same time. This compounds fast, and here's what I have learned from having up to 50 of them at once. There is a specific number of accounts where execution quality starts dropping, and that number is different for every trader. For some traders that number is 3, for some it is 10. For me, when I was actively trading, the number where I could still execute with full quality on every single account was around 6 to 8. Beyond that, I was making small mistakes, missing exits, taking slightly worse entries. Not because my strategy got worse, because my attention was split too thin. So what do I do about this? Well, two things. First thing, I figure out what my own execution limit is, and I do it honestly, not what sounds impressive, not what I wish I could handle. The actual number where I can still execute every trade at full quality. Second thing, even if I own more accounts than that limit, I do not actively trade all of them at once. I group them and I rotate. Some are being trading this week, others are in cooldown, others are waiting for the next payout cycle. This is the 1/3 rule I have talked about in other videos. Now the point is, owning accounts and actively trading them are two completely different things. Scaling is not about how many you can buy. It is about how many you can execute on correctly. Layer 3, and this is the part that nobody talks about, and it is probably the most important one in this whole video. The quality of your execution must not drop as you add accounts. Because here is what happens to most traders. They start with one account and they are patient. They wait for clean setups, they execute every trade like it matters. The first account hits consistent payouts. Then they add a second one and a third one. And suddenly they are not quite as patient. They take a setup that is 70% of what they would have taken on account 1. Because with more accounts, there is the feeling that you need to be more active to just justify having them, to generate good returns across all of them. That is the exact moment scaling breaks down. Your edge is your setup standards. If your setup standards drop because you feel you need to trade more often to justify having more accounts, you have just destroyed the thing that made you profitable in the first place. I learned this the hard way when I was at that 50 account number. What I noticed was that I was taking trades across all of them that I would never have taken if I only had one account. The standards had slipped without me noticing. And then a bad run came through and took out multiple accounts in just a week. The lesson from that, and this is the rule I follow now, the number of accounts you own should never change the quality of the setups you take. If you not take that trade on a single account, you do not take it just because you have 9 other accounts that also need trading activity. Every account you add needs to be executing at the same exact standard as the first one. If you notice your standards dropping because of volume, that is a signal to stop adding accounts. Stay at the current number until execution quality is back to 100%. Layer 4. How to actually manage the operational side of running multiple accounts, because there is a lot more to this than most people realize. When you have one account, you wake up, open your platform, trade, journal, done. Simple as that. When you have multiple accounts, you kind of have a business, and if you do not treat it like one, it falls apart. Here is what I actually do, and this is going to sound simple, but most traders do not do any of it. First, I cluster my accounts. Accounts on the same platform with the same rules, they get grouped together. Because if I'm trading a setup, I want to be able to execute it across that cluster at once without having to check different rule sets on every single one. Group by firm, group by account size, and group by rule set. Second, I have a separate tracking system for each of these clusters, not for each individual account, for each cluster, because clusters share rules. So I track the cluster as a unit. Total drawn unavailable, distance to payout across all accounts, rule breaks to watch for. Individual account tracking is too granular when you have that many accounts. Third, I stagger my payouts, meaning I do not try to hit payouts on every account in the same week. That would mean every cluster maxing out at the same time, which means every cluster entering the danger zone after payouts at the same time, which is exactly what happened to me during the bad run that I mentioned. Multiple accounts just passed payouts, all at slightly more risk than normal, all hit by the same bad week. Stagger them. Some cluster is always hitting payout. Some is fresh, some is just in the middle. Fourth, I have clear rules for when an account comes out of rotation. If an account gets close to daily loss limit, it goes to cooldown the next day. If a cluster has a bad week, the whole cluster pauses for a few days. No exceptions, no overriding my own rules because I want to keep trading. This sounds like overhead, and it is. Scaling is not just about multiplying returns. It is about building the systems that let you run multiple accounts without losing track of any of them. Layer 5, and this is the hardest lesson I learned from my 50 account phase, the one that nobody wants to accept. More accounts does not always mean more money. Think about it this way. If you have one fund account and you execute perfectly, you make X amount of dollars. If you have 10 accounts and you execute perfectly across all of them, you make 10x. That is the math every trader runs in their head when they think about scaling. But that math assumes you execute perfectly across all 10 accounts, which is almost never true. What actually happens when most traders scale is their execution quality drops from 100% to maybe 70%. And 70% execution across 10 accounts is worse than 100% execution across 3 accounts. Let me say that again because this took me years to accept. 3 accounts executed perfectly will often outperform 10 accounts executed at reduced quality every single time. When I was at 50 accounts, my actual income was not 50 times what it had been at 1 account. It was more like 15 times because I was trading 50 accounts at 30% of my actual execution quality. The math of scaling only works if you maintain the quality, and most traders cannot maintain it past a certain number. So how do I think about this now? I scale until I feel my quality is dropping. The moment I notice myself making execution mistakes because of volume, I stop. I do not add more. I might even reduce by a few accounts to get back to the quality I had before. The goal is not maximum account count. The goal is maximum return per unit of attention. Those are two different things and most traders confuse them. Build to the point where you are still executing at the same quality as when you had 1 account. When you hit that ceiling, that is your number. Do not push past it just because you can. The bad run will eventually come, and when it does, you want to be running a number of accounts that you can actually defend properly. So to bring all 5 layers together. Layer 1, do not add account 2 until you have consistent payouts on account 1, real cash in your bank from withdrawn profits, and the cost of the new challenge fully covered. 3 boxes all ticked before you scale. Layer 2, find your execution bandwidth. Not the number of accounts you can own, the number you can actually trade at full quality. For most traders, that is somewhere between 3 and 10. Honest self-assessment is required. Layer 3, scaling should never reduce setup quality. If you notice your standards dropping because of volume, that is a signal to stop adding accounts. Your edge is your standards. Protect them above everything else. Layer 4, run it like a business. Cluster accounts by prop firm and rules. Track by cluster, not by individual account. Stagger payouts so you are never all exposed at once. Have clear cooldown rules and actually follow them. Layer 5, more accounts does not always mean more money. Execution quality multiplied by account count is what matters. 3 perfect accounts beats 10 sloppy ones every time. I scaled to 50 accounts and learned the hard way that owning accounts is not the same as executing well on them. The real scaling move is not how many you can run. It is how much return you can generate per unit of your actual attention. 8 years, over $2 million in payouts. This is the framework that I use now, which is slower but disciplined. Quality over volume every time. That is what real scaling actually is. If you want to build this system properly with real guidance behind the system, I have a mentorship program called the Prop Firm Blueprint. This is only for traders who are serious about scaling with prop firms without blowing up. You can apply using the link in the description. And if you are looking for a trustworthy prop firm to scale on, I recommend Hola Prime. They have the fastest payouts in the industry and have just been audited by a real third party. You can use the code NFX for 30% off. The link is in the description. Thank you guys for watching this video. See you in the next one.